Hello, everybody. We'll just give it another minute or so for everyone to kind of trickle in, and then we'll go ahead and get started. All right, good morning or afternoon, wherever you guys are. Thank you so much for joining us today on this webinar about understanding the payments revenue food chain. We're really excited to share this with you and chat. This is going to be definitely an interactive kind of webinar, so if you have any questions at any time, feel free to put them in the chat or the Q&A feature, and we will go ahead and get those answered as best we can as we go through this. And with that, I'm going to pass it off to Ted.
Great. Thanks, Andrea. Welcome, everybody. I'm Ted Vandenberg, the VP of Revenue Operations at Infinicept. So I'm responsible for solution consulting and sales enablement and sales operations. And I've been in the payments industry for a long time, so I'm happy here to share some thoughts on how things are progressing and what's happening, and hope to hit the right level of detail for everyone to help you understand the payments revenue food chain. Like Andrea said, please feel free to pop a question in the chat window, and I will try to get to that when there's a good break in the discussion, and also at the end. You can save them to the end if you'd like, your choice. So let's dive in. First thing is that payments revenue is big business. We know that companies, I hear from them all the time, whether they're software platforms or venture capital firms, everyone is looking at the payments revenue in business. It's growing tremendously, and it's a really important part of any kind of business. How you accept payments, how you monetize that component of your business. When I started in the payments industry long time ago, the value proposition of taking credit cards, there was a fee for a merchant to take a credit card, and the value proposition was that you can sell something to a consumer who doesn't actually have the money. That's the whole point of a credit card, right? That was the initial value proposition. And for that, you pay a fee, but it was great because you could get someone who didn't actually have the money and would pay off their credit card company for that. So it was a real benefit for merchants. That value proposition has changed over the years. It's moved more towards the electronification of payments, the data, the digital aspect. How could you ever sell something online without having credit and debit cards, right? So there's still a tremendous value to accepting electronic payments and card payments. It's just that value proposition has shifted. What's really important is that everyone is looking at it. Everyone is focused on it. Your investors are looking at it. Your leadership, your executives are looking at it. And if you're not taking the most revenue from payments, then you're missing out. So let's talk about this food chain that we call it. These are the major participants in electronic payments. On the left side here, the first one are the merchants. They're the people selling a product or service. They need to take payments. Everyone uses a software package of some kind to accept payments, whether that is a terminal sitting on the counter is running software on it, whether that's a website that has a shopping cart. If it's a restaurant, they have some type of a software where they're taking orders or placing orders. If maybe it's a field services company that has plumbers and electricians going out. They need software to run their business. So software companies are in this food chain no matter what, because that's how our world works. Next, you have the processors, gateways, and ISOs. I lump those together because these are the people that traditionally provide the payments capability. They work with the card brands, the networks, to make that credit card transaction happen. The card brands create the rules. Visa, MasterCard, American Express, Discover. They make sure that everything works and people have a good structure to keep the criminals out and that are following the rules. And then we have the banks. The banks are always part of this payments network, and they serve a couple different functions that I'll go into a little more detail next. In this kind of a food chain thing, something that I've seen in my career, really in multiple industries, is that the company that's closest to the customer generally takes the largest piece of revenue. And then there's a spectrum of players that are taking smaller pieces of revenue, but with bigger volume. And that's, I think, definitely applies in the payments world, where the merchant will take a large part of revenue in smaller quantities, and then all the way over to the card brands and banks are taking small slices, large volumes for their participation in this whole food chain. So keep that in mind, that there's that revenue component throughout. Every player gets some revenue, and it's kind of the specialization of what they're doing shifts over time and can shift based on the priorities of that particular business. That's why we have the processors, gateways, and ISOs kind of clumped together, because there are companies that just act as a gateway, but there are companies that are a gateway and an ISO. Some are a processor, gateway, and ISO all together. So there's specialization that happens there, and that's moving into the software space and the merchant space as well. So let's look at these definitions a little bit of who's involved in a transaction. First of all, there is the acquiring bank. The acquiring bank is the merchant's bank. They are responsible for paying the merchant. The processor, and the examples, the large processors, FIS, WorldPay, Fiserv, First Data, Adyen, TSYS. There are a lot of large processors. You could become a processor. You really have to be processing billions, 5 billion or more before it makes sense to build that kind of infrastructure and platform. The processor is an important part of making the transaction happen. The gateway is how the transaction gets to the processor, and it's what the point of sale is coded to. It's what a shopping cart is coded to. It's also responsible for encrypting the transaction, routing it to the right processor. Processors have their own gateways, and there are also third-party gateways. So there are a lot of choices out there, a lot of really good gateways that do other specialized functions. So sometimes gateways are considered the software company that's enabling payments. Then the card network, Visa, MasterCard, Discover, American Express, they create the rules and regulations for everyone to participate in this ecosystem. And then the issuing bank is the bank of the cardholder, the consumer. So that's where the two different banks come into play. Sometimes it's the same bank. A lot of banks do card issuing, issue credit cards to consumers. They also are merchant banks, so they serve that acquiring bank role. Now I'll walk through the anatomy of a transaction, how it happens. And this is sometimes considered kind of payments 101 type discussion, but it's good to get everybody on the same page and make sure you understand how it works in the whole system. So the first, a consumer uses a card, a debit card, credit card to make a purchase. They settle that transaction with their acquiring bank and processor. Sometimes they don't know who the bank is. It's just the processor that they've signed up with. And I have a little bubble there that says ISO. And the ISO stands for Independent Selling Organization. or sales organization. And that was an organization, a kind of a definition that emerged in the 80s and 90s to help the processors extend their reach into other markets. So it was a sales arm of the processors, and sometimes they built other functions to customize to meet a certain market's needs. So they had a certain way that they presented the billing, certain way that maybe they had a gateway. ISOs were an extension of the processors back in the 90s when they were created. So a merchant may work with an ISO, they may work directly with the processor and acquiring bank. When a credit card transaction happens, the processor submits it to through the card networks, which matches it up to the issuing bank. Issuing bank is the cardholder's bank who approves the transaction. So if you have enough credit, your account is in good standing. There's some fraud controls that happen there on the issuing side, where you may, as a consumer, have gotten a little alert from your bank that says, hey, is this really you making this large transaction? That's out of your profile. That's an important fraud mitigation process there, where the issuing bank has profiles and knows their consumers. And so they give the yay or nay on whether that's a valid transaction. They send the information back, that approval, through the card networks, and then the acquiring bank gets the funds and they pay the merchant. So that's the entire life cycle that happens when someone swipes a credit or debit card. It's way more complicated than most people think or understand, what's happening behind the scenes. But this is the model today. Now we have the software platforms. I mentioned that on that first or second slide, that every business uses software. Everyone needs to have some kind of software, and they can be vertical software packages or platforms, things that serve just one particular vertical, like this company Run Sign Up that helps events, running events, manage their the 5K or marathon or whatever that they're running. Modernizing medicine, an example for medical, rent, so many different examples here of vertical and horizontal software companies. Some are point of sale companies that help merchants of all types, cafes, small retailers. Everyone uses software. That's the main point here. How are they going to play in this? Well, the thing that merchants have done for a long time is that we call the referral model. They may have provided a software for the merchants. Whether that was field services management or running event management, and they needed a way to collect payments. So their clients using their platforms needed to collect payments from customers. And so they'd say, great, let's work with a payment provider. Let's talk to a processor and send the merchants over to that processor to get a merchant account set up. And getting a merchant account set up is kind of like applying for a mortgage. You have to fill out lots of paperwork. You have to go through underwriting checks. You have to be approved. You have to provide all kinds of documentation, all that kind of stuff. It's not really a fun process that anybody wants to go through. It's just been a requirement of doing business. To get a merchant account, you have to go through that approval process with a payment company. That's what everybody's been doing for a long, long time. It still could be a fit and the best way to go for a high risk company. Because if you're a platform that is serving high risk merchants, you may not want to take the liability. You might not want to be responsible for their payments. So it's best if you just refer them off to that payment company. Say, throw it over the wall, say, you deal with it. I want to focus on my software. Or if you're just getting started and have pretty low volumes, not established, so you don't really need that control. You don't want that control or ownership. You want to focus on just building your portfolio and getting more clients on board. However, so those are the couple of reasons why a referral model, it existed, it still exists for some people. The payment facilitator model was developed by the card brands to accommodate this new reality of software platforms being in this prominent position of serving merchants. That they recognize that that's the way the world is going, and that's the best way to be inclusive and have as many companies as possible participating in electronic payments. That's what this model is for. It's the modern approach. It's the new approach to getting payments out to people. It's through software. So if you are a software platform, you process more than $50 million a year. If you want to have ownership and control the payment program, so maybe things weren't working so well with a referral model, you pass them off to a payments company, you don't really hear back, you don't know the status of your customer. They provide this awkward kind of support where your customers contact you, but then you have to tell them to go call this other company. There are a lot of issues with not having ownership of your payment program if that's a core component of what you're offering your merchants. So this payment facilitator model is designed for the software platform to be in control. And then companies who want more revenue. This is another big reason why the payment facilitator model is so popular and why it's growing so fast, is because companies want more revenue. They want a bigger piece of the pie. This is the way to do that. Any other models out there, there's kind of a spectrum of things that have evolved, but they really are more like a referral model. You're sending it to another company who is in charge. The contract is with them. They have the data, all those things that look like a referral model. So those are the kind of the two ways of doing things now. So what does it take to be a payment facilitator? What does that really mean? So in the traditional referral model, you're a software company, you have a platform, you might provide POS software, you might have some other kind of vertical management software, and you have a sales team and you do marketing to get more clients, right? And then when someone needs payment processing, one of your clients needs payment processing, you throw it over the wall, you send it to a referral partner, to a processor. They do underwriting, boarding, reporting, authorization, funding, merchant management. They do all of these tasks that are required to process payments. Now, there is a change. The payment facilitator model basically involves taking on those responsibilities. So you get the full revenue from payments, and you have ownership of the data, and you control that experience with your clients by taking on these functions. And some people paint a really scary picture. They say, oh, compliance, oh, fraud, risk, scary, scary, and all these things. But it really is very quantifiable, and it involves certain functions of doing the payments where you have to do underwriting. That's part of compliance. You have to check KYC, KYB, which you would want to do anyway. If you're taking liability for the transactions, you want to manage your risk properly. You have to monitor their ongoing transactions, apply the fees that you're going to charge your merchants for those payment transactions, and do the funding. They're very definable, very concrete things that actually Infinicept helps companies understand exactly what they need to do and provides the tools to help them do it so they don't have to build it all themselves. So then you still are going to work with a processor who has the connection into the payments network, right, to do all those steps that we covered to make a transaction work. That part doesn't go away. It's the ownership and responsibilities of managing your merchants, which are your clients. That's the part that you're taking over. You're still going to send the transactions through a gateway. It's still going to go do that settlement with the issuing bank and the acquiring bank. But you're responsible for these pieces that touch the merchant, your client. This is what it comes down to. I love this slide because it kind of shows, here's the old way of doing things. Now here's the new way of doing things. So a little more detail on what those things are. Reporting. First thing, in a referral model, you sent your client over to a payment company. They provided all the reporting. Now, if you're providing the payments, you need to have reporting to show them what they processed, allow them to reconcile, show them the fees that you're charging them, what their revenue is. So reporting is something that all the merchants are going to need to gain insight into their business. Underwriting, you have to check to make sure that you should be working with these merchants and that you should be providing them with a payment program. So underwriting, very defined. There are a lot of tools out there. Infinicept has a platform that does this automatically. It has a nice dashboard to manage exceptions to different underwriting checks. So this is something that can be done with the right tools. It's really quite easy. Funding. You are responsible as a payment facilitator to fund the merchants, to pay them their money. Now, in the old days, and what some people say to scare people away from this model, the payment companies that want to keep that business, is they say, oh, you have to have a money transmitter license to do this funding, and that's not true. There is a method where the payment facilitator does not touch the funds. They do not hold the funds. They have the funds in a FBO account with the sponsor bank and merely direct the funding. So there's a difference between taking the money and taking ownership of it in your bank account and then dispersing it, which requires money transmitter licenses. And that's very expensive and very difficult to achieve. You can have the same effect, really, of that control by using a platform like Infinicept to direct the funding, and then we provide the instructions to the processor and sponsor bank, who then actually move the money. So if you don't touch the money, then you don't have to have those money transmitter licenses. Excuse me. But funding it's not necessarily a burden. It's a good thing because you get more of the revenue if you take the risk for the transactions. If you're taking ownership and risk, you're going to get more revenue. That's clear because you're not splitting it with some other company. But if you take that liability, you want to make sure you can control it, control your risk. And having funding control is the way to do that. Merchant management overall, it's the main function that you're doing by being a payment facilitator. You are going to see the chargebacks. You're going to pass those on to the sub-merchants. You're going to provide the reporting. You're going to provide the support. And again, it's one of those things, you don't have to provide customer support. You get to provide customer support. Why would you want to outsource that? If it's a key component of the platform, the service that you're providing your merchants, why would you want to outsource that? You can do a better job. You know your clients better, and you have the tools, the platform they're already working with. So provide that one-stop shop, that integrated customer support by providing support for the payments piece of the business too. So this is how software companies are moving up the food chain. This is where the shift is happening. And they're doing it the shift is happening because of the revenue they can get and the control they get and the ownership, that customer experience in the end. If we look at the revenue share, in the referral model, you can get a referral fee. Software companies can get a little kickback from their payment company. It's very common. The percentages vary, but the payments company is getting the majority of it. Whatever they say your rev share is, it's usually a percentage of their profit. So it's not like you're getting that much of the payment transaction revenue. You're getting a percentage of their profit. So they're sharing something with you, but they're taking the bulk of it. Then there's the acquiring bank, and the processor has fees. They're required components in card payments. The card brands are going to take a little cut, and then interchange is always out there, is going to be the biggest part. Interchange will vary based on the type of card that the consumer is using. So you don't think those those airline points and those cash back points, they come from somewhere, right? They come from the fees that the issuing bank charges the charges the merchant, basically. That's where that money comes from. So interchange is there, it goes to pay that card issuer bank. In the payment facilitator model, now we see that everything is pretty much the same, except that payments company is gone. Because the software platform has become the payments company. So now this payment facilitator is taking a much larger portion of the revenue and actually taking the top line revenue. So top line revenue is also called a discount rate. The full discount rate of a transaction, let's say, is 3%. So the 3% is on $100 million in volume, is our little example here, is $3 million. So by becoming a payment facilitator, per the accounting rules, if you are setting the fees and you are taking the risk for the transactions, that liability, if something goes wrong or there's a chargeback, you can count $3 million as top line revenue. That's huge. That's a huge boost over what you would get with a rev share on the payment processing. And way more than just a referral. If you're just passing that off and letting someone else do the payments, you're missing out on this huge piece of revenue. There are the other costs, though. Cost of goods in accounting language here. So 2 million, let's estimate, is for interchange and network fees. So that leaves 1 million in gross profit for the payment facilitator. And then an example, you are doing some more work. Remember those little bubbles that moved over to be your responsibility. You're going to have some software to manage payments, and you're going to have a staff to manage the payment program. Those are significant, though. It's not millions and millions of dollars a year. This is very typical. This is a very typical model. 3 million top line revenue, 2 million cost of goods, and 300,000 for the actual operating costs for the program leaves you with 700,000 in EBIT. And then as a bonus, because of that additional top line revenue, because you are owning the payments, we do see a significant boost in multiples because of that payments revenue. So very beneficial for a software company. This is why they're doing it. Another example here, breaking it down, very similar to that percentage example. This $100 item, 3% processing fee. This is on an individual transaction example. Interchange is $1.80. That doesn't change from the referral program to the payment facilitator model. That all has to do with the card that's coming in and being used by the consumer. Network fees also doesn't change. Acquiring fees, let's say their fees are about the same. It's that payments company that is taking 60 cents in the referral program and giving you 30 cents as a rev share, generates 300,000 in revenue. That's nice. 300,000 in revenue for not really doing anything is good, but you aren't in control. You don't have the contract. You can't expand your program because you don't have that relationship. You don't have that contract with them. And it may be a poor customer experience to send them off to another company for customer support. On the other hand, if that payments company isn't there, if you become the payments company, now you get that revenue. So you get 900,000 in this example. So a few different ways to look at it, but it's really hard to argue that it's a bad thing to take the top line revenue, take all that you can. So let's look back at that anatomy of a transaction. The process goes along like it normally does. You still have to have integration from your shopping cart or point of sale to a gateway that goes to a processor, goes through the card networks, the issuing bank. The funds go back to the acquiring bank. However, as a payment facilitator now, this is where you're inserted in the process to control the funds that go to the merchant. So you're controlling the onboarding of those merchants and making that decision. And you're also controlling the funding that is paid to them. What Infinicept does is provide a tool set for payment facilitators to operate. It's a payops platform that helps you run your payment program with tools that are very purpose-built for those functions. So this is really how things change. It's instead of the merchant getting paid, directly from this processor or payments company, they're getting paid from a payment facilitator. The card brands love this because it increases the number of merchants that are getting electronic payments. It's efficient because as a software platform, you know your clients, you're working with them, you're managing their business for them with your software. So it really builds that scalability better than the old ISO model that was just a reseller, just a sales channel. So the benefits, to summarize here, being a payment facilitator drives higher revenue and the valuation of your company. That is what we keep hearing over and over again from investors, from software companies. They want to take the top line revenue, and it's worth it if you're in a normal industry that is considered normal risk, so not a high risk business. If you're not taking the liability for transactions and managing it properly, you're probably overpaying someone else to do that. So it's like overpaying for insurance. If you're paying someone 30 basis points to take your risk, the typical risk is 1 basis point. So why would you pay someone 30 basis points to take what would be 1 basis point of actual losses? That's like overpaying for insurance. So you can control the payments, you can take that liability and increase the revenue. Take control of the experience. That's the other big thing. That's the other pain point we hear from people. We hear people that want to have more revenue. We hear people that have a bad experience with a referral model, passing it off to another company. You should own that. You can take control and do the best job working with your clients. And then a better product. There's a lot of talk, all these different embedded finance solutions, ways that you can provide lending. You can provide buy now, pay later features and functions, all kinds of really cool embedded finance solutions. And you can do that by owning the underwriting, by owning the relationship, owning the contract with your merchant. It's easier to add things on. And you can make a better product by having the payments embedded in part of your solution, not just integrated like the old days. You could plug in some code, but really it's that entire experience end to end of how you're bringing them onto your platform, how you're doing your underwriting, how you're making that decision, how you're communicating with them, how you're funding them, how you're resolving any kinds of questions or issues that come up about the payment processing. That's that whole customer experience. I'll pause to double check if there are any questions from the audience. Anybody have anything that's come up that you'd like to discuss? Okay, well, let's move on then. I have an announcement. We have a live demo of our PayOps platform coming up at the end of the month, June 30th. And we'd invite all of you to come along and see this demo, which will help give you a flavor for what Infinicept offers, what we provide in terms of tools. And that really helps you understand this responsibility of becoming a payment facilitator, what you have to do. We show you what you do on a day-to-day basis. It's not that hard. It's not the scary, unknown. We help companies. We've helped hundreds of companies do this. And so we'll walk you through everything. So please join us June 30th.
And just to pause you for a second, Ted, I put a link in the chat to everyone to go ahead and register for that demo if you're interested in attending. You can go ahead and visit that.
Oh, perfect. Thank you. That makes it easy. Yeah, click on that link. And the next announcement, if that's not exciting enough to see our demo, we have something even more exciting that is going to be even more valuable, and that is we have a conference coming up. So if you are tired of Zoom calls and spending all day, in your home office, join us here in Denver at the Infinicept Ignite Unconference. And it's called an unconference conference because it is not going to be a stuffy conference room with the air conditioning turned on way too cold. It is going to be fun. We're doing this at Coors Field in Denver. There's quite a nice baseball theme to everything. But this is an opportunity if you really just want to learn more about becoming a payment facilitator, about taking ownership and control of payments, come here and you can talk to our clients. You can talk to the people who have done it, why they did it. You can learn from them. You can talk to other people who are thinking about this. You can talk to our partners who contribute to this. In Infinicept, we provide a payops platform, but there are other partners in this ecosystem. There are gateways, there are fraud mitigation companies, there are processors. Other people are involved in making this happen. And so we've invited them all together to have some great collaboration and really great connections and great fun. So come here to learn more face-to-face, in person, and have some fun. And the link there is pretty easy, infinicept.com/ignite.
I added that one to the chat as well.
Cool, great. And last chance for questions. Well, not really last chance, because here on this last slide, I want to thank everyone for joining us. And here's my contact information, ted.vandenberg@infinicept.com, and my phone number. I'd be glad to talk with you, answer any questions that you didn't want to cover here. Oh, we do have some questions. Okay. The first one is, our tool available in different languages? We are working on that. It is on our roadmap, but right now it is English. So we are in English only. So that is coming in the future. How do players like Stripe and Adyen compare to referral models and PayFac? Well, this is kind of interesting. Stripe and Adyen are PayFacs, actually. And they offer what we've kind of come up with this name called PayFac Lite, where they're providing a lot of the benefits of being a payment facilitator, but they are extending their capabilities as a PayFac to their clients. So the Stripe Connect program and Adyen for platforms are designed for software platforms, and they put the work on you, just like you saw those bubbles move over from the payment provider over to the PayFac. They move that work onto you, where you need to do the merchant application. You need to do risk underwriting. They're going to take care of some compliance things like checking OFAC and match. They're going to do the things they have to do as a PayFac, but they're pushing the other responsibilities onto you to check the business risk of your clients. They have a tech stack where you would onboard the merchants, and then they also leave the responsibility to you of adding the fees and giving funding instructions. So they give you that flexibility and that capability, like a PayFac has, to direct funding, to be in control of that funding. So it's a little bit of a middle ground of a solution. It's not a full referral. It's not the referral model, and it's not a full PayFac, although Adyen does support clients who want to be full PayFacs. They have kind of both flavors. You can be a full PayFac, or you can use their platforms and not be a PayFac. And in any of those cases, you have responsibilities that you have to do And you can use Infinicept's platform if you don't want to build it all from scratch. So that's an example of being an almost payfac, having a lot of the benefits of it, but you still need to make sure if you're taking risk, because they're going to put for Stripe Connect and for Adyen for platforms, they're going to give you the liability. If you have the liability, you want to make sure you're managing the risk. You want to have the tools to properly underwrite and board the merchants, and you want to have the tools to monitor the transactions and control the funding to your sub-merchants. So those are the important things that you want to do if you work with Stripe Connect and Adyen for platforms. And then when if you're doing that, make sure you have the right tools, and we'd be glad to talk with you about that and benefits of using our platform instead of building it all from scratch, which could take a couple years. Okay, so I hope I answered that question. Are you supporting both card present and card not present transactions? If so, do you have a list of point of sale terminals to support Infinicept Payback program? So yes, definitely we support card present and card not present transactions. We do not provide point of sale terminals because Infinicept is not a gateway. So gateways are the gateways which may be part of a processor. So Stripe, for example, that from that last question, they have a list of they have terminals they provide. Adyen has a list of terminals they support. Third-party gateways have lists of terminals that they support. Getting the transaction from the terminal to the processor happens outside of Infinicept entirely. So that's not part of our solution. We chose not to be a gateway and not to get into that authorization flow. What we're here to do, what our PayApps platform does, is we help you board the merchant so they get their account in the first place to process. Then you need to have terminals and an integration to a gateway and processor, and you do that outside of Infinicept. We can help. We have recommendations, and we're in the industry and work with a lot of companies, so we can help guide you, but we don't directly do that. And then when those transactions settle, we're integrated to the processors we receive the transactions and then provide and give that to you in our interface so that you can apply the fees and that you want to charge your merchants, and that you can direct the funding to properly manage your risk. So we provide the kind of the bookends of the process, getting the merchants boarded and then funding and doing the settlement with the merchants. We don't provide the gateway or the terminals to authorize the transactions. There are thousands of companies that do that, and they do a really good job with it. It's really variable based on the industry functionality. You know, point of sale terminals are really designed for certain industry verticals. So we did not want to get into that business of supporting terminals and transaction authorization. It has to be perfect, run 100% uptime. We don't want to be in that business. So that's my answer to that. We don't provide terminals because there are lots of other good companies that do that to move those transactions to the processor. So do we support major processors like Fiserv or TSYS? Yes, that's the answer. Yes, we have a handful. We have pre-integrations that we have done for real-time instant merchant boarding, as well as we have a capability where we can work with any processor. If we're not pre-integrated, we have functionality to do that integration, and that would be another webinar topic, but we basically can support any processor out there. Every company promotes interchange optimization, indicating they can drive down interchange costs more than the competition. Is there any truth to this? There is, I'd say my opinion is that you do want to optimize interchange. There are methods to do that. There's a way to analyze the data, and there are more and more advanced ways all the time with AI to drive down costs. And a lot of that has to do with, my understanding is a lot has to do with how the transaction is the data is collected, because it's going to cost more. A hand-keyed transaction, for example, is going to cost way more than a chip transaction because you have fewer data elements. It's going to be higher risk of fraud and chargeback because you don't have that validation of the chip card. So there is a spectrum of ways that things that drive that cost, and companies, probably a lot of them, have the tools to look at your data and look at how you are sending the transactions to the processor, and if there are things you could do differently to lower those costs. So I think there is some truth to that. That's my opinion. There's another, there's always going to be opportunity in data analysis, both at that authorization and then at the settlement after the fact, to look and see how your costs are and what could be done to lower them and improve your efficiency. So I think there's a lot there, and every company probably has their own capabilities with that. So definitely, there's a lot out there. All right, any other questions? I'm glad we got a flurry of questions there at the end. Thank you for participating. And will we share the recording of this? Andrea, I think we will, right?
Yes, definitely. I'll be sending an email to all of you with a link to the recording.
Cool. Thank you. Thank you, everybody, for joining. Hope you have a great rest of your day, and don't forget to register for Infinicept Ignite and the demo of our PAPS platform. So we look forward to seeing you there. Thank you.
Thanks, everybody.